I'm Julia Cordova, and welcome to the Place Your Trades Network. We are the network that focuses on trading daily options using the CME Group event contracts to trade E-mini S&P, NASDAQ, Dow, Russell 2000, gold, silver, euro, crude oil, natural gas, and copper. Today, I have a great show for you. I have Lyn Alden from Lyn Alden Investment Strategy on. We're going to talk about what's going on with the banks, the market in general, and also what she thinks of commodities in this environment. Today's broadcast is brought to you by CordovaTrades, which has built a custom app dedicated to trading those CME Group event contracts. That's what we're all using at Place Your Trades. And if you don't have time to watch the show in entirety, or if you'd like a written summary of what Lyn and I discuss, just enter your email into the placeyourtrades.com website and we will send you out a synopsis. Okay, so I'm going to start off by quickly just giving you a general overview of the market, and then I'm going to bring Lyn right in. Okay, so this is the Place Your Trades website. You can see here we have our live streams. There's a chat function. Now, there's also quant stats. So whether or not the market opens up or down for each of the things that are traded, you'll be able to see just quickly if there's any sort of edge that the quant stats give you. I generally pay attention if it's 55% or greater, and then if the profit factor is over 1.3 or so. That's when I really start to pay attention. Now, the dashboard is new. If you scroll down, and by the way, all you have to do is enter your email. There's no obligation. It's free, whatever. But if you scroll down here, you can get a list of the event contracts and what the prices are they're going for. And then you can also get the probabilities based on what's going on in the market right now. And then something I really like is you can click on futures here and you can see what the performance is overall. So you can see natural gas is sort of outperforming everything right now. Do we trust it? I don't know. Then we've got oil, copper, and then we've got down to the market itself. And then you can see Bitcoin is not performing well, and it's not performing well strongly. And so you can sort of see all of that at a glance on the website. And then you're probably used to seeing this. This is the Tradovate web app for the event contracts. I like it on my phone because I can just quickly scroll through and see where everything is at a glance. And then if I want to, if I get to support or resistance, you can see ES is just flat right now. So if I click on that, I'm going to see 41.50. It's about 50-50 odds of closing yes above or no below. So if I were to take one of those trades, I would end up making $20 on that $10 if I was correct about that. And of course, you can go outside of the money, et cetera, to figure that out. And then I'm going to show you a new dashboard. This is the Tradovate website here, and we have a event contract dashboard on that website. And this is just the hourly chart. You can see that last week, and because this is all the way from last week, you can see last week was dip and then a touch of a buy, dip and buy, but we never really caught up with where we started, right? So NASDAQ, though, last week did end up super close to flat. NASDAQ was really strong. But you can just get a general overview of what's going on. You can see that we're chopping around. I did buy the dip this morning for a scalp, so I hope it works out for me. And then you can see the different event contracts here and see what the prices are, and then trade from a more professional setting. Okay, so that's it. Let me go ahead and remove my screen here, and let's talk to Lyn. So, hi, Lyn.
Hey, nice to see you.
Oh, thank you so much for agreeing to speak with me, coming on our program. I guess I realized when I was looking at your bio that you have an engineering background. Is that correct?
That's correct. Yeah, that was my first career before I got into investment research.
Wow. So, what kind of engineer were you?
So my background is electrical engineering, and I started out. Well, I actually started out doing industrial automation, but then during the global financial crisis, I shifted over to the aviation industry, and so I focused on aircraft simulation. Building aircraft simulators, operating them mainly for research purposes. And so I started out in design engineering and then eventually shifted more towards engineering management and technical procurement. So kind of blending the finances with engineering.
Okay, and so I love that. I'm a mechanical engineer by training myself. What made you transition into trading and investment strategy?
The way they often describe it is actually I came back to investing, and so actually my first passion in life was probably investing. So when I was a kid, I was like saving my money. I was like buying gold and silver coins, and then I got into equities. My first stock was Adobe, um,
Oh, wow.
something like 20 years ago. Um, and so I kind of my first passion was, I could when I was like 12, I could tell you like what the Nikkei level was at. Like I like whenever the news came on, I was like focused on the economic section. But in university, I went into engineering instead of finance, and so I had that kind of foray into engineering. And eventually, I just kind of on the side, I was still investing. That was kind of where I spent my free time. So a lot of it, some engineers that are really hardcore in engineering, when they go home for the day, they tinker with things. They continue to do engineering, when they're not on the clock. Whereas when I was not on the clock, I was doing investment research. And so it's kind of that thing like what do you do? What would you do for free is probably what you should also, consider doing as your main time. So I eventually shifted out of engineering and more towards that investing and research role.
So, but how? So, I think what you do is so fascinating because you are a macro person. You look at the environment that we're in, and then try to forecast based on what's going on now. What could happen based on the situation? How do you go about even learning something like that? Though that to me is like is incredible.
Mostly what I do is I take a systems engineering approach, and so most of what I did in my career after just initial electrical engineering was systems engineering, kind of that engineering management type of thing, where basically it's the thing that engineering and macroeconomics have in common is systems engineering is about kind of designing and managing systems that are too complex for any one mind to have the whole system in their head. So it's multiple engineers from different disciplines, electrical, mechanical, software, aerospace, all working on something. And the difficulty of managing a project like that, and there's inevitably going to be problems. There's all these inputs, there's all these outputs, and you have to have a systems approach, which is basically a couple ways of looking at it. One is that you analyze all the inputs and you have to determine what the outputs are going to be from those inputs. And when they don't behave the way you think they should, then you have to kind of go downstream and kind of solve all the different subsystems to see where the actual issue is and what are the breaking points that are breaking maybe before other things, right? So each part of the systems has limits. And so I generally take a systems approach to macro, and the reason I think it works is because macro really is about systems. I mean, these are human design systems at the end of the day. The banking system is a human design system. Global settlements are human design systems. Obviously, equities and things like that. These are human design systems, and they have this complex interaction, which is more complex than any of us can possibly take into account. But by having that approach, we can at least, have like an if else type of framework, which is we start to identify maybe the bottlenecks or the breaking points and then see, if this happens, then what is likely to follow. Kind of a similar type of approach.
Got you. Well, speaking of breaking points, I wanted to start out by talking about the banks because that's what everybody is talking about. But after I get your opinion on what's going on with the banks, I want to find out from you what you think no one is talking about, but should be talking about. So let's just start off with banks. We've seen the regional banks, they're failing left and right. Do you think that this is something that's systematic and could potentially have contagion, or do you think this is something that is mostly handled that is maybe close to an end in terms of the phenomenon? What do you think about that?
So compared to 2008, so 2008 was a big credit problem, and that was like a gigantic debt, private debt bubble unraveling. This one is obviously more of a duration and liquidity and interest rate type of challenge, and so this one's actually fully within the realm of policymaker control. So it's as bad or as easy as they want it to be relative to the other things they're trying to optimize for, which is primarily inflation, right? So at any time, if they were to cut rates and provide liquidity, the banks are fine to the extent that they want to, keep optimizing for inflation, then some of the weaker banks are more vulnerable to problems. So that's actually what the key difference is they really have the tools to address this one pretty easily, should they decide to. And so I think it's gonna be. I think the worst is probably behind us. It's kind of famous last words, but to the extent that it does get worse, they have the tools to then shift back and maybe let inflation run her hot while stabilizing the banking system. So they have a bunch of tools on their plate to be able to handle that. I would still be very careful of small banks. I'd be very careful of kind of the lower end of the regional banks, any sort of highly specialized bank. I'd be careful with banks that have a lot of commercial real estate exposure unless you understand that book very, very high detail. Um, I'm not too worried about kind of the global foreign banks too much, outside of the ones that are always in trouble. And I'm not too worried about say, the top 10 banks, um, generally, in the US. And so I think this is more specific and it's more controllable. And it's really about, basically, if you go back in history, right, how do you come off the zero bound? That's actually a really hard problem for policymakers to do. If you have old interest rates for zero for a long time, how do you eventually get out of that? Because the problem is that when interest rates are zero, you build up so much debt in the system that if you raise rates, it causes a massive problem. And the last time we were in this situation was actually coming out of the 1940s. They after that Great Depression, they eventually had inflation because they did so much fiscal. It was obviously war related, but they did a lot of fiscal. They created a lot of inflation. They inflated a lot of debt away, and they eventually wanted to come off of that zero bound. And back then, their policy was to let inflation run hot and to come off the zero bound gradually. This time, they're taking the opposite approach, where they've, they jacked interest rates up from like 0 to 5% in a little over a year, and so that kind of more ham-fisted approach has, you know, um, led to more bank instability. And they can always walk that back. They can slow it down. They can pause for a period of time, or they can, if they decide to, they can keep jacking that up. And so I think the policymakers going forward are going to balance between that inflation and financial stability kind of set of mandates. And investors obviously have to work around what they think policymakers are going to do there. But I think generally, with so many people talking about it, with so many policymakers looking at the problem, I think it's containable. And I think the thing that people are talking about is the thing that they were all talking about last year, which is energy and commodities. I think a lot of people have assumed that that's just fixed now. That we're completely done with any of our energy or commodity problems forever. It's kind of like last year's news. And while I don't really have an opinion on the next 6 months, like I don't, it really depends on again what policymakers do. I mean, if you slow the economy enough, then energy and commodities tend not to be a problem. But I think the issue is the next time they try to have a growth cycle, let's call it the purchasing managers index. The next time you have a big upswing in the purchasing managers index, or you know economic reacceleration in various forms, however you want to measure it, I think it's likely to come with another wave of inflation because some of the key drivers of inflation, even though they've been suppressed, have not really been fixed at their root level. I think we still have energy constraints on the supply side. I think we have copper constraints on the supply side. Some materials more than others. But I think those are a multi-year story that are going to come in waves. Um, uh, and I think that is, we've all kind of mentally just forgot. And now that oil's pretty cheap again, we've kind of forgot how much actually went into making that happen, right? So we had to draw down the strategic petroleum reserve. We had to put ourselves into what is kind of a near recession so far, and yet oil's still at the level that it is. So imagine what it is if we were to have another economic cycle without any sort of drawdown in strategic petroleum reserves or things like that. So I think that's probably what's not getting the coverage that it should. And the problem is that if it's not getting the coverage that it should, people aren't really working on fixing it as fast as they probably should be and taking the steps they have to do to give us, 5-year, 10-year, 15-year energy security.
Oh, that is fantastic. So, um, I guess a backup question though is, you know, after COVID, when the market was just going in a parabolic uprise, why do you think the Fed didn't act faster? Why do you think they waited? It seems like they waited, and then, as you said, they did everything all at once. Um, what do you think the motivation behind waiting was? And then, when do you think that they're potentially going to? I don't want to say the word pivot, but do you think they're going to pivot?
So I try not to read minds, but I did read a lot of literature and look at the numbers for what they were doing. And if you look back before the pandemic, there was a BlackRock paper with actually some former Fed officials advising it too, and they talked about how and this was something I was covering at the time, which is why I was looking at papers like this, which is that when you're already practically at the zero bound and you run into a recession, and you have this much debt in the system, what do policymakers do? And so back then, that was back when there was like, $18 trillion in negative nominal yielding bonds, inflation, all the magazine headlines were like, inflation's dead. How could we ever possibly have inflation? And, I wrote at the time that central banks and fiscal policymakers can generate inflation if they really, like print a crazy amount of money and just give it to people. Um, and or corporations for that matter. To print money, give it to small businesses, give it to large businesses, whatever they want to do. And so I was kind of looking at literature and see what policymakers were thinking. And one of the things that BlackRock paper covered was, probably the next steps were going to be okay, you go into recession, you cut rates to zero, that's not enough. So you do very large fiscal stimulus, but that could be inflationary. And if you try to raise rates, you kind of counter this fiscal stimulus you just did. And so you have to basically hold rates low and let inflation run hot for a period of time to kind of restart things. And it's funny because that's kind of the step-by-step playbook for what they did, except everything was dialed up to 10 because it was not just a recession, it was a pandemic and lockdowns and madness. Um, and so that's kind of the playbook they were going with, where the Fed even said, we're not even thinking about raising rates. We're going to have an average inflation targeting, meaning we're, because their official inflation metrics ran below their level, they were comfortable letting them run higher their level. Um, I think where they pivoted was I mean, and Jay Powell talked about this in Congress before inflation came. Congressman asked him, they said, "What do you think about the recent 25% year-over-year money supply growth rate?" That was back then. That was back in like 2021. And he basically said that, from their models, monetary aggregates are not very important for the economy. They have to unlearn the importance of monetary aggregates. And I think that's just a wrong model. I think they underestimated the importance of broad money supply. It was very different than the actions of 2008 because the fiscal portion was much larger and more direct. It's not just bank reserves being recapitalized this time. It was actually the people and businesses being recapitalized, basically money going out to them, increasing their spendable money into the economy. Um, and so I think the inflation wave hit harder and faster than they thought. And then it became the number one political issue. If you looked at polls at the time, inflation was the biggest thing. And so the Fed had to basically understand that the models were wrong, and that as much as they would have liked to have let inflation run hot for a period of time, it became so hot so quickly that they had to change into it. And, I think the second mistake then was trying to do everything right away. Basically, instead of just accepting there's a mistake now and you can fix it over time, it was like, let's turn on a dime and go from 0 to 5% rates, which when you have that much debt in the system and you're coming off of that low of a level, you're going to break a lot of things. And instead of letting that policy kind of like take its time to go through the economy, allowing refinancings to happen over time, they kind of just rammed it all through at once. And I think we're probably still going to be dealing with those side effects for quite a while. I don't think we're done dealing with the side effects. And I think the final point I'll make there is that when you hear Jay Powell talk, he's mostly referring to the 1970s. He's referring to Paul Volcker. He's comparing himself to Paul Volcker essentially. And I think the challenge is that the inflation dynamics we're seeing today and recently are more like the 1940s, which is that, in the 1970s, inflation really had two big components. One was obviously the supply side, like oil limitations, right? So domestic oil production in the United States peaked in 1970, and after like 100 years of going up, it rolled over conventional oil production, and so it became more reliant on imports, and therefore we had all those geopolitical challenges and supply shocks and things like that. But number two, you had a demographic surge. The baby boomers were entering their home buying years. And so you had a lot of lending driven money supply growth. That was basically the peak period of US domestic bank lending. So you did have some money creation from fiscal stimulus, basically the guns and butter policy, but the majority of money creation was coming from banks, and therefore the act of one, fixing the supply side through geopolitical means, and two, trying to tighten monetary policy did do a lot to quell inflation. Whereas 1940s, we had just as high inflation. Actually, the year-over-year figure was higher in the 1940s, but the average for the decade was around the same. Um, and the difference was that banks were not lending back then. That was not from excessive bank lending. Money creation was not coming from banks. It was coming from very large monetized fiscal stimulus, which was obviously war related. But a lot of that war related spending was domestic. You were building manufacturing facilities. You were getting commodities. When the GIs came home, there was the GI Bill that sent eight million of them to college and technical school and then subsidize their mortgages. Basically, that's a domestic stimulus, a fiscal stimulus. And so you had this huge money supply growth monetized by the central bank and the broader banking system. And so, very big surge in broad money, quite inflationary. Um, and rates don't really affect that. Like rising rates doesn't really affect how much the government's going to spend. And if anything, it actually makes them have larger deficits because they're paying higher interest on their debts, and that's adding to the deficit and actually contributing to money supply growth as you take money supply growth out from elsewhere. And so I think basically the dynamic we're facing now is that inflation is going to be a rolling concern as long as fiscal deficits are very, very large, and as long as we have supply constraints on the commodity side. Now, that doesn't mean we have inflation every year. In the 1940s and 1970s, inflation came in waves. So you'd go up really high, then you'd have a disinflationary period, and then you'd have another spike in inflation. And it's because central banks and policymakers did fight back for periods of time, and especially in the 70s, you had price and wage controls, you had central banks trying to tighten. In the 40s, you didn't really have the central bank fighting back, but you still had things like wage controls and rationing and things like that. There were attempts to try to, address the demand side to try to quell prices, and we're seeing that somewhat now. But I think the thing that's a risk going forward, and that not enough people are talking about, is that even though we have this recent inflation wave under control, there's a risk of future waves of inflation because those underlying dynamics are not addressed, which are the commodity supply side and the ongoing fiscal deficits.
That actually super aligns with my technical outlook as well. So I'm happy to hear you say that. I just want to remind people that this is a lot of information. If you would like a synopsis of what Lyn is talking about today, just enter your email into the placeyourtrades.com website and we will send you out a synopsis. So another question I had though was, uh, with the global, do you believe that there is a global de-dollarization movement going on? Do you believe that other uh, world superpowers, if you will, are planning to try and unseat the dollar? What do you think about the dollar here and the geopolitical environment of using the dollar as a de facto currency?
So the short answer is yes, but it's more nuanced than that. And so you generally see a lot of these headlines like, death of the dollar, dollar de-dollarization,
Right.
things like that. On the other hand, you see a lot of people saying nothing's going to change. This is a nothing burger. That's doom. That's like, doom saying, and nothing's going to change. And I think the extremes tend to be wrong. But I think we are seeing a trend change. I actually wrote an article back in 2020 called "The Fraying of the U.S. Reserve System," which was basically analyzing some of the costs of the system, how the system's changed over time, and how the world's likely to trend towards a more multipolar direction, which is to say that it's not another country's currency that's going to come and take over, right? So we're not going to all be using yuan in 10 years. But it is to say instead that the world is likely headed in a more multipolar direction. And if we step back a little bit, this is somewhat inevitable because the system that's been in place is in many ways unnatural, and things that are unnatural are kind of hard to maintain. And so after World War II, the United States was basically king of the world, right? Our homeland was mostly untouched by the war. We had, huge trade surplus. We had a huge positive net international investment position. We had an intact manufacturing base. We had tons of gold. Other countries even shipped their gold to us for custody, for safekeeping during the war. We had, unrivaled military strength, economic size, and so we had over 40% of global GDP. And so we basically could make all the rules, and we could become the new ledger and take over from Britain. and that obviously was a kind of a multi-step phase. Um, but over decades, um, you know, the fact that you have 5% of the population and 40% of the global GDP naturally started to revert back towards somewhat of a more even baseline. If you look back long enough, I mean, China and India used to be very large percentages of the world economy. They're reasserting themselves as being a very large percentage of the economy, um, and so things are kind of returning towards equilibrium, I would say, which is the equilibrium is somewhat multipolar. Um, and so now that the United States is down to, depending on how you measure it, between 15 and 25% of global GDP, we're no longer the biggest commodity importer. That's China now. Over the past 20 years, China has replaced the US as the biggest trading partner for most countries. So you look at most of African countries, most of Asian countries, Australia, even most of Europe, even parts of South America. The United States is no longer the biggest trading partner with most of those countries, and instead China is number one, and the United States is often number two. Um, and so in that kind of world, um, the United States is still unrivaled in some areas. I mean, we have, the biggest, tech sector. We have the language network effect, the cultural network effect. We have, the most uh, obviously the strongest navy, so the ability to project power at longer distances than other countries. We have better rule of law than obviously China and many other countries, and basically deeper, more liquid capital markets. So we still have a number of strengths, but the world is obviously spreading out more. And things get accelerated from time to time where trends start to roll over, but then something kicks into high gear. So we were already seeing that the world that foreign central banks were really not acquiring treasuries anymore. Um, and but the events around Russia invading Ukraine, then us cutting off Russia, kind of accelerated some of these actions. Where a number of these countries say, I'd like to diversify my reserves now. Maybe it's buying gold, maybe it's splitting reserves up, maybe it's buying commodity rights, whatever the case may be. I think we're seeing a more distributed reserve practice going forward. And then we're also seeing an acceleration in national blocks building alternative payment systems, so that should they get sanctioned, or even if they don't get sanctioned, they can route payments, without going through New York, right? That they can just route payments, a more decentralized world for payment structures. And so when you take those two things together, more decentralized payments and more decentralized reserve practices, I think in some ways we are seeing a at least a trend change toward de-dollarization and a more multipolar world. Now, you don't really see that among the public, right? So, like if you look at, say, people in Argentina or Brazil or Nigeria, things like that, they want dollars, not yuan, on the street, right? It's not
Right.
like the dollar's not really losing any power there. It's funny because, like, if you look at stable coins, um, over 99% of stable coins are dollars. Anyone can create a stable coin and issue another fiat currency, and they do exist. There's even stable coins that are backed by gold. But in practice, what everyone wants is dollars. So when Lebanon's like currency collapses, they start using dollars as stable coins and things like that. Same thing in Argentina, same thing in Nigeria, to a less extreme extent. And so there's still a obviously a very strong network effect for the dollar. So this is not something that goes away overnight. And I disagree with Ray Dalio in some areas, but one of the charts that he does, he has a set of charts for his changing world order, um, you know, uh, thesis that he has. And one thing he does, he looks at reserve currencies over time in history, like the countries behind them. So the United States, Britain, Netherlands, whatever the case may be. And he maps out various metrics for lack of a better word, empires. And he looks at their education quality, their manufacturing quality, their economic size, their military power, their reserve currency status. Um, and you see that some of them are leading indicators and some of them are lagging indicators. So things like education are leading, other things like economic and military might are kind of coincident, so they're kind of at the center, and reserve currency status is actually lagging. So it comes up more slowly after those other things are built and dominant, and then even after those other things kind of hit their peak and start to roll over, and are no longer as competitive with the rest of the world as they were before, reserve currencies, because of the network effects and because of the just entrenchment, they tend to hang around longer and be one of the last things to hit their peak and then gradually roll over. And so I think we're seeing a similar thing with the United States, where many of the fundamentals are already a more multipolar world. The dollar is, probably past its absolute peak in terms of the percentage of total reserves and things like that. But it still has that existing network effect and still therefore takes a long time to roll over as all these countries kind of try to figure out the frictions of dealing with, more currencies. I mean, we see, for example, India and Russia have had a multi-year plan to trade more. That was before the war. And then even during the war, India said, okay, we'll buy all the Russian crude then. Um, and so, they also buy arms from them. And so you see a lot of Indian and Russian trade. But the challenge is that, at least in that arrangement, India's running a trade deficit with Russia because India's importing their commodities and their arms. Um, and Russia doesn't know they don't want a ton of rupees. And, so there are challenges. The Indian market's not really deep and liquid enough and desirable enough for Russia to want to just plow all of their surpluses back into Indian assets. And so the question becomes, what do you settle in? What is the reserve asset that you're going to settle in? And so there are frictions with all these countries trying to use something other than the dollar. So this is like a long-term thing, in my opinion.
So I love that you brought up gold specifically, because when I think of silver and gold, I don't think about commodities. I think about them as currencies, because they don't generally trade in the direction of a lot of
Yeah.
commodities. Do you think that if somebody were to look for a safe place, a lot of people have asked me, "Hey, is my money safe in gold?" Do you think? I mean, it's hard to, of course, predict the future, but do you think that gold is on some sort of super cycle right now?
I think it's attractive as a slice of a portfolio. I mean, I own gold. Um, I kind of look at it as a big cup and handle pattern, for lack of a better way of describing it. That'd be my base case expectation. Obviously, I can't predict the future,
Right.
but I do think if you look at central bank gold reserves, um, they were declining from the 70s until around 2009. That's when they hit their low point. And then ever since the global financial crisis, you saw like a V-shaped trend line where central banks started accumulating again. So it went down from something like, say 37,000 tons down to like, 29 to 30,000 tons. And they've kind of built back up to that prior, like, 37,000 ton level. I don't have the exact numbers in front of me. Um, and that's, in recent quarters, that's continuing. They're kind of that's kind of the one money that they can hold, that if they self custody it, it's got no counterparty risk. It's kind of inbuilt inflation protected because supply only grows by something like 1.5% per year, and so they have that degree of protection. Um, and so I do think that gold reserves and gold price in general, I think has a constructive outlook in a more de-dollarized world and a more inflationary world on average. Um, I think large investors are generally under exposed to that. Retail investors have kind of been big on gold coins and things like that, but you don't really see like large pools of capital that interested in it. And so if they ever do kind of leg into it, there's a lot of upside potential. So I do think that gold's pretty attractive, and I agree with you that it's mostly monetary premium. It does have industrial uses, but gold is mostly money. Silver's kind of in that hybrid
Right.
scenario. And so, for example, I do look at things like the gold and copper ratio. It's kind of like almost magic when you compare the gold and copper ratio to purchasing managers index. They're kind of ebbing and flowing at the same time. And that's because really, gold trades more like a safe haven and copper trades more like obviously an industrial metal. And so you generally see those types of characteristics. But I do think that gold is one of the assets that is probably going to do well between now and 5, 10 years from now, uh, compared at least on a risk adjusted basis compared to many other types of assets.
Right. Okay. So, what about Bitcoin? I mean, you know, I was a late adopter of Bitcoin. I was somebody who sort of poo pooed it, and then it went to the freaking moon, right? After a lot of times of not going to the moon. But do you think it's something that will ever go away? Do you think it's something that will actually ever be used as sort of a I guess it is mainstream currency right now. It's just that if people are holding it, expecting it to go higher, then they're not spending it. You know what I mean? So
Yeah.
what do you what do you think of Bitcoin in general? And do you see a path for Bitcoin to potentially go higher?
So I am long-term bullish on Bitcoin. I don't really have a view on the next 6 months or so because if you look at what drives Bitcoin in short and long term, it's quite different. So short term, Bitcoin is one of the tightest liquidity plays. So, and there's different ways to measure liquidity. Like cross-border capital has their liquidity metrics, and Bitcoin tends to follow them pretty well. There's also like if you just take global M2 and you denominate it in dollars and you look at it in year of year rate of change terms, generally Bitcoin's price is pretty correlated with that. So obviously that's taking into account both the dollar index and just the rate of broad money supply growth globally. So, when people say it's an inflation hedge, what it actually is kind of is a money supply growth hedge. And that tends to precede inflation, which is why, you had money supply growth and Bitcoin go up together. And then when central banks tried to stop money supply growth and tried to raise rates, that's actually when a lot of assets, including Bitcoin, ran into headwinds. Um, and so, I am long-term bullish on Bitcoin. I like the fundamentals, for lack of a better word. Obviously, it doesn't have cash flows like gold, but basically it has use cases. And when you look at the use case of something like Bitcoin, you know, gold is useful, but you can't really bring it globally, right? Whereas Bitcoin, you can memorize 12 words and you can go anywhere in the world and you can then re-access your Bitcoin eventually. And so that kind of this like shared global ledger that, yeah, anyone with an internet connection can access, which is at this point more people in the world than have bank accounts. More people have smartphones than bank accounts. And obviously it's got over 90% of the proof of work market share. It's got, it's still the largest market cap of any cryptocurrency. It's the most decentralized. And so I'm quite long-term bullish on it. You just have to have if you have like a near-term view on it, you have to have a view on liquidity. Whereas long-term, it's more about the fundamentals. Like, do more people want to hold this versus now, or do less people want to hold it? And I think the fundamentals point to more people wanting to hold it. I also pay attention to the startup ecosystem. I do a little bit of VC investing in the Bitcoin startup space, and so I look at companies that are building on top of Bitcoin, making use of Bitcoin, and those are still doing quite well. And they have a lot of really cool products that are coming out in the months and years ahead. And so the network keeps getting easier to use, um, more useful to use. And to your prior point about spending, the way that I kind of view it in phases. So when Bitcoin is in its adoption phase, which is basically that it's, that it's below its level where if everybody understood Bitcoin, what percentage of them would want to hold Bitcoin? I don't think we're at that level yet. I think that is still an underappreciated, understood asset. And so in this kind of low adoption phase where most people don't hold it, those that do mostly don't hold meaningful amounts of it. Um, I think it's kind of in that sort of investment speculation phase where you're kind of analyzing the network, you're envisioning what could be, what is likely to be, and you're holding it mainly for that reason. And what you're kind of holding is a stored up ability to make payments should you need to, right? So maybe you don't want to, buy your coffee with it now, but the fact that if you hold Bitcoin in self custody, you can bring that anywhere in the world, which you can't do necessarily with your equities, with your gold. And for us in the United States, that doesn't seem like an important trait. But for Nigerians and for Argentinians and for Lebanese people and for South African people and for Vietnamese people and for people around the world, that's a pretty powerful trait. That global portability of an asset. I think when we think globally, that's the use. And as it eventually reaches, I think, a larger adoption, more liquidity, less price volatility, then it becomes more useful and interesting as a spending currency. Even now, I mean, there are things like, for example, there's a protocol called Nostr, and you can use it to build things like a decentralized Twitter, and you can use it to build other things, and they can all interact with each other. So kind of like how, like if I use Gmail and you use Yahoo Mail, I can send you an email because they both use the same underlying protocols.
Right.
Like right now, Twitter and Facebook don't really talk to each other. Whereas with something like Nostr, you can have different social media ecosystems and clients that actually talk to each other. And one of the things that Nostr does, for example, is they incorporate Bitcoin Lightning tips in a similar way that Twitter has likes. And so you can just, with the click of a button, send someone Bitcoin instantly. And it uses the second layer on Bitcoin, which is called Lightning. And it just does that super quick. And you can use whatever wallet. You can use a custodial wallet. You can use a non-custodial wallet. And so you have all these different ecosystems sending signals, monetary signals to each other. And it's I think it's kind of neat because it's like when you have identity and money, like identity and a wallet mixed together, um, like anyone on Nostr, I can send them money in 10 seconds. Whereas I can't do that. I have friends and I have to say, okay, what is your payment details? What is, what platform do you want me to use? Things like that. Whereas I think the value of this kind of digital money is that you can have these combined identity and wallet services or protocols, actually not really services, but open source protocols, and make use of that over time. And I think that one of the things that this opens is that when you have less friction of cross-border trade in kind of a global unit, it opens up, I think, a lot of really powerful workers in countries that have just kind of been underrepresented in the global field. And kind of results in more globalization of white collar work than we've seen. Whereas, when we think of globalization, we think of outsourcing, we often think of manufacturing. But I think there's a lot of creative professionals and engineers and programmers and graphic designers and things like that around the world that now, with this type of technology, are more interconnected with the rest of the world. Like, one of the companies I work with in the startup space, for example, they have employees or contractors in like Argentina and like Lebanon and Turkey, and they pay them with Bitcoin because it's easier to do. And so it's not something you necessarily want to use all the time, but there actually are circumstances where paying with Bitcoin makes sense.
Oh, I love that. So I want to transition a little bit. So there's a bajillion reasons for a lot of people to be bearish right now on the market, and I realize that the market is different from the economy, right? But the market has so far shrugged off, these interest rate hikes. It's shrugged off the regional banks, going down one by one. Uh, what do you think is happening there? Why do you think that is it greed? Is it just the technicals? I like to think it's the technicals. What do you think is happening there? Why is the market ignoring some of these huge red flags that are publicized everywhere?
So I think the things you listed are relevant. So greed, technicals, all sorts of things like that. I would also add liquidity. And so when the central bank responds to a crisis with some degree of liquidity injection, even if it's not permanent liquidity, it's just more money in the system. That can be good for a lot of asset prices. Also, it changes our forward expectations of how hawkish the Fed's going to be, and so you kind of have that good news is bad news reaction, assuming that asset in question is not part of the bad news. So if banks are blowing up, then people say, well, I guess that means tech stocks have a green light because the Fed, it kind of limits the tightness they can do, and therefore those longer duration assets can catch a bid. I think that's kind of the thought process we see in the market. Now, I think the bearish case would be that they're underestimating um, earnings, slowdowns, and that would, obviously affect the fundamentals of those companies if they were to slow down materially. Um, but one thing I would kind of back up is if you go back to the idea of a somewhat inflationary decade, and a decade um, that's especially driven by fiscal driven inflation. Um, one thing is if you look at emerging markets, equity markets, when they go through a recession or a currency problem, their equities often do decently in nominal local currency terms, even though they're doing poorly in dollar terms. Because if you have a stagflationary recession or an inflationary recession, nominal prices aren't always the best signal. It's really kind of the real numbers. And so I think stocks have been doing pretty poorly in inflation adjusted terms since the end of 2021. They've obviously not been doing great in nominal terms either, but it's even worse in inflation adjusted terms. And so my expectation is that stocks are not going to have a very good inflation adjusted like 5+ years performance. I think this is likely to be somewhat of a lost decade in inflation adjusted terms, or priced in gold, or price. basically or price in a basket of commodities, let's say, right? So I think when you have a harder unit and you're measuring what equities are going to do this decade, at least in aggregate, I think it's not attractive. If you when we in 2021, not only did you have high classic valuations like Shiller PE ratio, um, and market cap to GDP. Another metric I like to look at is household assets as a percentage of the total assets, right? So in 2009, partly because of valuation contraction and partially because of people pulling their money out, they were underexposed to equities compared to their average. Whereas in 2001, both again because of valuation increases and because of heavy allocations, investors had record high exposure to equities. Um, and so there's really, in my view, not a lot of marginal capital that can come in and keep just grinding to higher and higher valuations, even if you might reclaim nominal highs at some point. I don't really expect that to happen anytime soon, but it's certainly possible. But I think that the problem is that as a percentage of total assets, and in inflation adjusted terms, equities are probably unlikely to do very well, but that they might still do better in nominal terms than the bears expect, when you have that kind of just ongoing cyclical inflation problem.
So that's interesting because that actually brings us back to what nobody's talking about. What should be talking, maybe that people should be talking about is, I'm not sure that the bottom is in terms of the oil price, but I do believe that when there is a U-turn, when that bottom is in, that potentially we could go up pretty quickly. That's just my technical outlook. I don't know, but do you think there could be an environment where potentially stocks maybe stay inside of a range, but things like oil and other types of commodities start to go? I mean, I guess when you're talking about cycles, do you think something like that is possible?
I do. I think, and I kind of have a similar view fundamentally. I'm glad to hear the technical support that. Um, during this falling, we've been in a period since 2021 of decelerating economic growth. So we still have positive economic growth roughly, but we're decelerating in terms of that growth. And so I like to visualize that with the Purchasing Managers Index. It's kind of the baseline description, but there's other ways to look at it. So we've had falling PMIs, and so a lot of risk assets tend to do kind of poorly in falling PMIs. So copper rolls over relative to gold. Oil tends to have a rough time. Obviously, it had a good 2022, partly because of the war and supply side issues, but it's been kind of stagnant. It's obviously come down a lot from its highs since then. And so as long as that's kind of falling and down, it's not really a good catalyst in the super near term for a lot of these types of assets. And we'll see what kind of liquidity issues we have this spring and this summer with the debt ceiling, and then post debt ceiling when the Treasury tries to refill its cash balance, which is pretty bad for market liquidity. There's a lot of things to navigate that I think could absolutely push oil lower for a period of time. I don't really have a high conviction on that, but I think it's certainly within the realm of reasonableness. And then, but I would be a kind of a buyer of that type of capitulation,
Right.
because I think that when you get past that, when you get to a reliquefaction phase, when you get to the next economic reacceleration, like we talked about before, all the fundamentals, all the supply side issues are still there, and I think they're ready to reemerge as soon as right now we're holding the volleyball underwater. We're like really we're kind of pressing down, we're holding down demand. We're getting excess supply out of the Strategic Petroleum Reserve and pushing that in the market. We're kind of doing everything we can to kind of hold these things down and quell inflation. And once, say, recession or financial instability becomes a bigger topic than inflation, and they try to start putting out that fire instead, I think the problem is that those inflation factors are ready to come back out. The volleyball is ready to pop back out of the water when it's not being held down. And so that's kind of how I would think about the long term, and then how people want to get into those positions. Obviously, that's more technical, that's more sentiment. That depends on how what duration people manage their portfolio with.
Mhm.
But I would look towards those fundamentals as being still supportive long term.
Wow. I have loved speaking with you today. Lyn, you are amazing. It was wonderful to talk to a fellow woman engineer who somehow got into finance, and you're just fantastic. Um, Lyn's handle is LynAldenContact on Twitter. She's got a website, LynAlden.com. You could sign up for her free newsletter there. I don't know why anybody in the world would not. It's brilliant. And I just encourage everybody to follow Lyn, follow Place Your Trades on Twitter. And again, if you would like a synopsis of today's conversation, all you have to do is enter your email address into placeyourtrades.com. We will send you just a short summary of what Lyn and I talked about. And yeah, thank you so much, Lyn. I appreciate it. And
I appreciate you having me, and I like the work you do. Huge fan, and I'm glad to be here.
Oh my gosh, thank you so much, Lyn. Okay, everybody, have a great trading day and week, and I will talk to you on the other side. Okay, bye.